At this precise moment, something remarkable is occurring with your financial assets, and you're likely unaware. If you own silver or have been considering purchasing it, the following minutes could deliver the most crucial financial intelligence you received this year. What I'm about to reveal isn't speculation, propaganda, or the sensationalized material that floods your feed daily. Every fact, figure, and assertion in this presentation is verifiable. I've placed all reference links in the description, so you can independently confirm everything. Stay with me through to the conclusion because the silver market is experiencing something unprecedented in over 4 decades. The opportunistic implications for your personal finances are absolutely enormous. Banks are scrambling, vaults are depleting, and prices are behaving in ways that contradict everything mainstream financial media predicted. This is your narrative now, unfolding in real time. As I create this content, silver is trading aggressively around the $82 mark per ounce. Trading floors across New York became active as screens displayed green instead of the red many institutional traders had anticipated. Major bullion banks had positioned for a vastly different outcome, one that would have seen silver retreat toward the $40 range that TD Securities had publicly projected. Instead, global appetite for physical metal overwhelmed every paper short position established in preceding weeks. The CME Group selected this particular moment to officially launch their new 100-ounce silver futures contract, a decision that immediately raised questions among independent analysts. This smaller contract size was marketed as a retail-friendly futures market expansion designed to make precious metals more accessible to everyday investors. However, this launch's timing coincided with the most significant physical supply squeeze the silver market has experienced in 40 years. Western vault inventories have been steadily depleting as metal flows eastward toward Asian markets where industrial demand has reached unprecedented levels. The ratio of open interest to COMEX registered inventory stands at a staggering 416%, a mathematical impossibility if even a fraction of contract holders demand physical delivery. Registered inventory refers to silver actually available for immediate delivery against futures contracts, as opposed to eligible inventory, which is simply stored at the exchange. Current estimates suggest only between 28 million and 103 million ounces of silver are actually available for delivery at the COMEX. Meanwhile, paper claims against this inventory run into hundreds of millions of ounces, creating a situation where the exchange cannot possibly satisfy all demands for physical metal. The Shanghai Gold Exchange currently trades at a $6.50 premium over New York spot price, creating an irresistible arbitrage opportunity. This premium means anyone who can acquire physical silver in New York can immediately profit by selling it in Shanghai, effectively draining Western supplies. The People's Republic of China has implemented export restrictions on silver, meaning metal entering Chinese territory doesn't leave. This one-way flow has accelerated dramatically throughout 2025 and into the current year, creating what industry insiders call a structural deficit. The global silver market is experiencing an annual deficit of approximately 200 million ounces, meaning demand exceeds new mine supply by a massive margin. This deficit has persisted for 4 consecutive years, drawing down above-ground inventories that had accumulated over decades of surplus production. The artificial intelligence revolution has created entirely new categories of silver demand, from advanced semiconductor packaging to high-performance computing thermal management. Data centers require massive silver amounts for electrical connections, thermal conductivity applications, and specialized electronics powering artificial intelligence systems. The electrification of the global vehicle fleet demands silver for every electric motor, battery management system, and charging infrastructure component. Unlike gold, which is primarily held as monetary reserve and jewelry, approximately 56% of annual silver demand comes from industrial applications that physically consume the metal. Once silver is used in a solar panel, it cannot be economically recovered, meaning this industrial consumption permanently removes metal from available supply. The recycling rate for silver remains stubbornly low because the metal is used in such small quantities per application that recovery simply isn't cost-effective. Mining production has plateaued despite higher prices because silver is primarily produced as a byproduct of copper, lead, and zinc mining operations. Approximately 70% of annual silver production comes from mines where silver isn't the primary target, meaning production responds slowly to price signals. New mine development requires between 7 and 12 years from discovery to first production, meaning current supply constraints cannot be quickly resolved. Major silver-producing nations include Mexico, Peru, China, Poland, and Australia, with Mexico alone accounting for approximately 24% of global output. Political instability in Peru has disrupted production from several major mining operations, contributing to supply uncertainty in the global market. Labor disputes, environmental regulations, and declining ore grades have all constrained existing mines' ability to increase output. The average grade of silver ore has declined by approximately 40% over the past 2 decades, as the richest deposits have been exhausted. This declining grade means miners must process increasingly large volumes of rock to extract the same amount of silver, driving up production costs. All-in sustaining costs for primary silver miners have risen to approximately $15 per ounce, providing a fundamental floor under market price. The margin requirements imposed by the CME Group during their previous week reached 18%, a level designed to cool speculative enthusiasm for silver. These elevated margin requirements mean traders must deposit significantly more cash to maintain positions, theoretically reducing speculative activity. However, these same margin requirements are now functioning as what analysts call a reverse margin trap, creating enormous costs for institutions with large, short positions. When silver was trading at lower levels, maintaining a short position required relatively modest capital. But at $82, the carrying costs have become enormous. JP Morgan Chase has historically been identified as a major participant in the silver market, holding substantial positions that move markets when adjusted. HSBC Holdings has similarly been a major player in precious metals markets, operating large vault facilities and trading operations in London and New York. Deutsche Bank, Goldman Sachs, and various other global financial institutions maintain active precious metals trading desks that participate in both physical and paper markets. The London Bullion Market Association coordinates the global over-the-counter precious metals market where the vast majority of large transactions occur. London lease rates for silver, which measure the cost of borrowing physical metal, have climbed to 6.3%, indicating severe tightness in the physical market. When lease rates rise, it signals that physical silver is becoming difficult to obtain, regardless of what paper futures prices might suggest. The disconnect between the paper price set in New York and the physical reality of empty vaults represents the core tension in the current silver market. Industrial buyers who actually need silver for manufacturing have begun bypassing traditional banking channels to secure physical bars directly from refiners. This disintermediation removes the traditional inventory buffer that allowed banks to manage price discovery in precious metals markets. Major refiners in Switzerland, including Valcambi, Pamp, and Arger Heraeus, have reported unprecedented demand for industrial delivery of silver products. The Royal Canadian Mint and Perth Mint have both implemented allocation systems for silver products due to overwhelming demand from industrial and retail buyers. Premiums for physical silver products over spot price have expanded dramatically, with some retail products commanding premiums exceeding 30%. This premium expansion demonstrates that buyers are willing to pay significantly more than the quoted futures price to obtain actual physical metal. The United States Mint reported record demand for American Silver Eagle coins throughout 2025, repeatedly selling out of available inventory. Authorized purchasers who buy directly from the Mint have faced strict allocation limits, preventing them from obtaining the quantities their customers demand. The secondary market for previously minted silver coins and bars has seen premiums rise even faster than for newly produced products. Generational wealth transfer dynamics have introduced new buyers to the precious metals market as younger investors seek alternatives to traditional financial assets. Social media communities focused on silver accumulation have grown exponentially, creating a grassroots movement of investors committed to acquiring physical metal. The hashtag #SilverSqueeze that emerged in 2021 has evolved into a sustained movement with millions of participants worldwide. Unlike the brief speculative frenzy of early 2021, current silver demand appears to be driven by fundamental supply and demand considerations. Institutional investors, including pension funds and endowments, have begun adding precious metals allocations as inflation hedges and portfolio diversifiers. Exchange-traded funds backed by physical silver have reported consistent inflows, with the iShares Silver Trust adding millions of ounces to its vault holdings. The Sprott Physical Silver Trust, which stores its metal in Canadian vaults outside the traditional banking system, has seen particularly strong demand. Investors increasingly understand the distinction between paper products and fully allocated physical metal held outside the banking system. The concept of counterparty risk has entered mainstream financial discourse as investors question whether their silver holdings actually exist as physical metal. Central bank gold purchases have reached record levels, with institutions adding over 1,000 tons annually to their reserves in recent years. While central banks don't typically hold silver, their aggressive accumulation of gold has focused attention on precious metals as monetary assets. The de-dollarization trend among BRICS nations has accelerated demand for hard assets that exist outside the Western financial system. Russia, China, India, and other nations have increased their precious metals holdings as they reduce exposure to dollar-denominated financial assets. The weaponization of the dollar through sanctions has motivated sovereign wealth funds to diversify into assets that cannot be frozen or seized. Silver's dual role as both an industrial commodity and a monetary metal positions it uniquely in this environment of geopolitical tension. Historical silver-to-gold ratios have averaged approximately 15-1, reflecting the relative abundance of the two metals in the Earth's crust. The current ratio exceeds 80.1, suggesting that silver may be dramatically undervalued relative to its historical relationship with gold. A return to historical ratios would imply a silver price exceeding $200 per ounce at current gold prices, a target that once seemed impossible. The gold price itself has reached unprecedented levels, providing a powerful tailwind for silver as investors seek precious metals exposure. Gold's breakthrough above $3,000 per ounce in 2025 established new paradigms for what precious metals prices could achieve. Silver typically outperforms gold during the latter stages of precious metals bull markets as investors seek higher beta exposure to the sector. The volatility of silver has historically been approximately 1.5 times that of gold, making it more attractive to speculative traders. This volatility works in both directions, creating larger percentage moves both up and down compared to the more stable gold market. The technical chart pattern for silver shows a clear breakout from a multi-year consolidation range that kept prices between $20 and $30. The breach of the $50 level in late 2025 triggered massive short covering by institutions that had positioned for lower prices. Each subsequent resistance level has fallen as momentum traders pile into the market, anticipating further price appreciation. The $83, $85 level represents the next significant technical resistance where algorithmic trading systems are expected to trigger additional buying. Hedge funds that remained on the sidelines during the January volatility have been waiting for confirmation of the trend before establishing positions. A sustained move above $83 is expected to bring substantial new capital into the silver market from systematic trading strategies. The Commitment of Traders report, published by the Commodity Futures Trading Commission, reveals the positioning of various market participants. Commercial traders, typically producers and industrial users, have reduced their net short positions as prices have risen, indicating acceptance of higher prices. Managed money accounts, primarily hedge funds and commodity trading advisors, have increased their net long positions to multi-year highs. The swap dealer category, which includes the major bullion banks, shows historically large short positions that become increasingly costly to maintain. Open interest in silver futures remains elevated despite the price increase, suggesting that new capital is entering the market rather than just short covering. The March delivery month represents the next critical test of the physical market's ability to satisfy the demands of futures contract holders. Historically, the vast majority of futures contracts are rolled or cash settled, with only a small percentage standing for physical delivery. However, the current environment has seen a dramatic increase in delivery notices as industrial buyers use the futures market to secure physical metal. The exchange has the option to settle contracts in cash rather than physical metal, but exercising this option would destroy confidence in the contract. A forced cash settlement would represent an admission that the paper price has diverged from physical reality, potentially triggering a panic into physical metal. The COMEX has never been forced into widespread cash settlement of silver contracts, but the current inventory situation has raised legitimate concerns. London Metal Exchange nickel trading was suspended in March 2022, when a short squeeze created a similar situation in that market. The LME's decision to cancel executed trades and halt trading created lasting damage to confidence in that exchange's price discovery function. Silver market participants are keenly aware of this precedent and the potential for similar interventions if the COMEX faces delivery difficulties. The difference between the nickel situation and silver is that silver has a far larger and more liquid physical market with many alternative venues for price discovery. The March delivery cycle represents the most significant test of the COMEX silver market's integrity in the modern era of commodity trading. First position day for the March contract falls on February 28th, when traders must declare their intention to make or take delivery of physical metal. Historically, the days surrounding first position day see elevated volatility as positions are adjusted and rolled to later contract months. The current environment suggests that an unusually high percentage of long position holders intend to stand for delivery rather than roll their contracts. Industrial users who actually need silver have found that the futures market remains the most cost-effective way to secure physical supply despite elevated premiums. Unlike retail purchases, where premiums can exceed 30% over spot, futures delivery involves only modest costs above the contract price. The challenge for the exchange is that available registered inventory cannot satisfy even a small fraction of outstanding contract claims. If significant numbers of contract holders stand for delivery, the exchange must either find additional metal or face a default scenario. Finding additional metal requires convincing holders of eligible inventory to convert their holdings to registered status and make them available for delivery. This conversion requires the current owners to agree to sell their metal at the prevailing futures price, which many may be reluctant to do. Large holders of eligible inventory include industrial users, refiners, and investors who have stored metal at COMEX warehouses for their own purposes. These holders face no obligation to convert their holdings to registered status and may prefer to retain their metal for their own needs. The exchange can raise storage fees, adjust delivery procedures, or take other administrative measures to influence behavior, but cannot force conversions. The structural problem is that decades of paper derivative expansion have created claims against a relatively static base of physical metal. When confidence in the paper market begins to crack, the scramble for physical metal accelerates in a self-reinforcing feedback loop. The Kevin Warsh Federal Reserve nomination created a brief interruption in this dynamic, suggesting that hawkish monetary policy might crush commodity prices. The nomination of Kevin Warsh to lead the Federal Reserve was interpreted as a signal of tighter monetary policy ahead. Warsh, who served as a Federal Reserve governor during the 2008 financial crisis, is known for his concerns about inflation and monetary discipline. The market initially interpreted this nomination as bearish for precious metals, triggering a sharp but brief sell-off in both gold and silver. Silver declined from its highs to the low $70 range during this Warsh shock period, creating temporary optimism among short sellers. However, the market quickly realized that even the most hawkish Federal Reserve cannot manufacture physical silver to satisfy industrial demand. Monetary policy can influence demand for silver as a financial asset, but the industrial consumption that drives the structural deficit is largely inelastic. Solar installations will proceed regardless of interest rates, because the economics are driven by electricity prices and regulatory mandates, not Federal Reserve policy. Electric vehicle adoption will continue because of manufacturer commitments, consumer preferences, and environmental regulations already in place. Artificial intelligence infrastructure build-out will accelerate because competitive pressures demand continued investment in computing capacity. The realization that physical demand will persist regardless of Fed policy triggered the sharp recovery that has brought prices back above $80. Short sellers who added to their positions during the Warsh shock now face even larger losses as the price resumes its upward trajectory. The new 100-ounce silver futures contract launched by the CME Group has generated intense debate about its true purpose and likely effects. Proponents argue that the smaller contract size, 1/5 the size of the standard 5,000-ounce contract, will attract new retail participants. A 100-ounce contract at $82 represents approximately $8,200 of silver exposure per contract. This is significantly more accessible than the standard contract, which represents over $400,000 of exposure at current prices. Critics argue that the timing of this launch suggests an ulterior motive related to the challenges facing major short sellers in the market. The smaller contract size could allow institutions to more gradually unwind their losing short positions by offsetting against retail long buyers. This theory suggests that the exchange is providing a mechanism for large traders to exit their positions without triggering the massive price spikes that would occur in the standard contract. The 100-ounce contract settles via accumulated certificates of exchange, ACE, rather than through traditional warehouse receipt delivery. This ACE mechanism pools multiple smaller contract holdings into larger warehouse units, potentially complicating the delivery process for retail participants. Understanding the specific mechanics of any contract is essential before trading, as the details of delivery and settlement can significantly impact outcomes. The silver market has a long history of institutional attempts to manage or influence prices dating back centuries. The Hunt brothers' attempt to corner the silver market in 1979 and 1980 remains the most famous example of speculative activity in this market. Nelson Bunker Hunt and William Herbert Hunt accumulated massive silver positions that drove prices from approximately $6 to nearly $50 per ounce. The COMEX responded by implementing liquidation-only trading rules that prohibited new long positions, effectively forcing the Hunts to sell. Silver subsequently crashed, the Hunts declared bankruptcy, and the episode became a cautionary tale about speculative excess in commodity markets. However, the current situation differs fundamentally from the Hunt episode in that demand is being driven by genuine industrial consumption rather than speculative accumulation. The industrial silver deficit is not a speculative position that can be liquidated. It represents actual consumption that permanently removes metal from available supplies. Mining production cannot respond quickly enough to fill this gap, meaning the deficit will persist for years, even at significantly higher prices. The silver market is also far larger and more globally integrated than it was in 1980, with price discovery occurring across multiple venues worldwide. Asian demand, particularly from China and India, now represents a far larger share of global consumption than during the Hunt era. The Shanghai Futures Exchange provides an alternative price discovery venue that can offset attempts to manipulate prices in Western markets. Indian silver demand, driven by traditional cultural preferences and wedding season purchases, adds another layer of physical buying that supports prices. The Middle Eastern market, centered in Dubai and the United Arab Emirates, has grown significantly as a hub for physical precious metals trading. This geographic diversification of the silver market makes it far more difficult for any single institution or exchange to control price outcomes. The jewelry and silverware sector continues to represent a meaningful portion of global silver demand, approximately 17% of total consumption. Investment demand for coins, bars, and exchange-traded products has grown substantially over the past decade, now representing approximately 25% of consumption. Photography, once a major source of silver demand, has declined dramatically with the shift to digital imaging, but still consumes several million ounces annually. Electronics applications beyond solar and computing, including switches, contacts, and batteries, consume significant quantities of silver each year. Medical applications, including wound dressings, antibacterial coatings, and medical devices, represent a growing category of silver consumption. Water purification systems increasingly use silver-based technologies due to the metal's powerful antimicrobial properties. Brazing alloys and solars used in manufacturing and construction represent another significant category of industrial silver demand. The diversity of silver applications means that demand is not concentrated in any single industry, providing resilience against sector-specific downturns. This demand diversity contrasts with metals like lithium or cobalt, where demand is heavily concentrated in battery applications. Silver's essential role in the green energy transition has attracted attention from governments and international organizations concerned about supply security. The International Energy Agency has identified silver as a critical mineral for the energy transition subject to potential supply constraints. The European Union has included silver on its list of critical raw materials, recognizing the strategic importance of secure supplies. The United States has begun considering domestic production incentives and strategic stockpile programs for critical minerals, including silver. The Department of Defense has historically maintained strategic stockpiles of various materials considered essential for national security. While the silver stockpile was largely liquidated during the 1960s, current supply chain concerns have revived discussions about rebuilding reserves. Domestic silver production in the United States has declined significantly from historical peaks, leaving the nation dependent on imports. Alaska, Nevada, and Idaho contain significant silver deposits, but permitting and environmental challenges have constrained new development. The Coeur d'Alene mining district in Idaho, once the world's leading silver-producing region, now represents only a small fraction of global output. Mexico's dominance in silver production means that any disruption to Mexican mining operations could significantly impact global supplies. The nationalization trend in Latin American mining, seen most recently in lithium operations, has raised concerns about the security of silver supplies. Bolivia's substantial silver reserves remain largely underdeveloped due to political instability and challenging investment conditions. Argentina has attracted mining investment with more favorable policies, but development timelines remain long and uncertain. The investment case for silver has strengthened considerably as the magnitude of the supply and demand imbalance becomes more widely understood. Institutional analysts, who previously dismissed silver as too volatile, have begun recommending allocations as part of diversified portfolios. The correlation between silver and traditional financial assets has declined, making it a more effective diversifier than in previous decades. During periods of financial stress, silver has increasingly traded as a safe haven asset rather than purely as an industrial commodity. The 2020 market disruption saw silver initially decline with other risk assets before staging a powerful recovery. The pattern of silver strengthening during periods of monetary expansion and currency debasement has remained consistent throughout history. Every major fiat currency in history has eventually lost purchasing power, while silver has maintained its fundamental value over millennia. The Roman denarius, originally composed of nearly pure silver, was progressively debased until it contained virtually no precious metal content. This debasement contributed to the economic decline of the Roman Empire and the loss of confidence in Roman monetary systems. Similar patterns of currency debasement have occurred throughout history, from Chinese copper cash to American silver certificates. The United States abandoned silver coinage in 1965 when the rising price of silver made the metal content worth more than the face value. Coins minted before 1965, known as constitutional or junk silver, contain 90% silver and are actively traded in precious metals markets. The current generation of investors, having experienced multiple financial crises and unprecedented monetary expansion, has developed a healthy skepticism of fiat currencies. This skepticism has driven demand for hard assets, including real estate, commodities, and precious metals. Silver's combination of monetary history and industrial utility makes it uniquely positioned to benefit from both inflationary and industrial demand trends. The $82 price level represents not just a number on a trading screen, but the culmination of decades of structural forces in the silver market. Mining underinvestment, industrial demand growth, monetary policy expansion, and geopolitical uncertainty have all contributed to this moment. The banking institutions that have historically managed the silver market through their dominant positions are finding their tools increasingly ineffective. Paper derivative expansion cannot solve physical shortages. The market is finally forcing recognition of this fundamental truth. The investors who recognize these dynamics early and positioned accordingly are now seeing the vindication of their analysis. Those who still doubt the sustainability of higher silver prices are invited to examine the supply and demand data themselves using the references provided. The March delivery month will provide additional clarity about the physical tightness in the market and the ability of shorts to source metal. Beyond March, the June and September delivery cycles will present additional tests of market structure as the deficit continues to accumulate. The silver market is entering a new era where physical reality asserts itself over paper abstraction, benefiting those who hold actual metal. The $82 price represents not a ceiling, but a foundation for further appreciation as the structural shortage intensifies. Patience and conviction have been rewarded for silver holders, and the fundamental case for continued strength remains compelling. The financial education provided in this presentation aims to equip viewers with the knowledge needed to make informed decisions about their personal financial situations. Every individual must assess their own circumstances, risk tolerance, and investment objectives before making any financial decisions. The information presented is educational in nature and should not be construed as personalized investment advice. The references provided in the description allow for independent verification of all claims made in this presentation. Thank you for your attention and commitment to understanding the forces shaping our financial world.